When a country finally decides to regulate crypto, the first fear is usually, here comes a crackdown. But Kenya's Virtual Asset Service Providers Act did not take that route. Instead, it took a surprisingly balanced, modern approach, something rare in a world where most governments still see crypto as a threat, not as an opportunity. Let's get into what Kenya actually got right. First, and probably most important, is recognition. For years, crypto traders in Kenya operated in a shadow economy. Banks wouldn't touch them, the taxman didn't know what to do with them, and investors saw them as high risk. This act changes that narrative. It doesn't just define crypto, it recognizes it as a legitimate part of the financial system. That's not a small step. In global terms, it's a difference between being outlawed and being invited to the table. The second win is the licensing framework. Now, that word licensing makes some people nervous. But think of it like this: licensing brings trust, and trust brings investment. Without a license, you're a random exchange. With one, you're a recognized institution that banks, investors, and international partners can actually work with. Kenya's move mirrors what Singapore did under its Payment Services Act, a licensing regime that transformed its crypto industry from a gray market into a trusted fintech sector. Today, Singapore is home to giants like Crypto.com and Binance's regional operations. That's what legitimacy can do. Third, Kenya did not leave regulation to one body. It took a multi-regulator approach. The Capital Markets Authority handles investment aspects, token offerings, asset management, and advisory services. The Central Bank of Kenya, CBK, oversees payment systems, wallets, exchanges, and stable coins that touch fiat. And the Financial Reporting Center, FRC, monitors AML compliance. This layered oversight system reduces conflict and aligns each regulator with its core strength. The EU did something similar under MICA by coordinating among national regulators and the European Securities and Markets Authority. That is innovative governance. The fourth strength, and one I personally appreciate, is how Kenya's act aligns with global AML and counterterrorism financing standards. The crypto world has suffered from reputation problems, scams, hacks, dark web transactions. Kenya's VASP Act directly references Financial Action Task Force principles from the US. It mandates that all licensed providers maintain transaction records, verify customers, and report suspicious activity. Now, some may see that as intrusive, but in reality, it's what allows serious players like banks, insurers, institutional investors to get involved finally. Without AML and CFT alignment, the crypto world stays isolated from traditional finance. With it, we can finally build bridges. Another thing Kenya got right: consumer protection. For years, retail investors had been burned by Ponzi tokens, fake exchanges, and rug pulls. The Act mandates that any VASP must have proper capital requirements, insurance, and transparent ownership structures. It even includes clauses on cybersecurity, conflict of interest, and protecting customer assets, making CEOs personally accountable for breaches. That last part is huge. It means if an exchange goes down or mishandles funds, the leadership cannot hide behind the company name. That's the kind of accountability the industry desperately needs. Let's talk about innovation next. One of the strongest sections in the Act is how it treats tokenization and digital assets. It acknowledges that real-world assets like real estate, art, or commodities can be represented as tokens. That's forward thinking. It's the kind of language that puts Kenya on the same path as the UAE and Switzerland, where tokenization is already powering billion-dollar asset markets. Imagine a day when a small investor in Nairobi can own 1% of a downtown property via blockchain. That's the world this act quietly enables. And speaking of forward thinking, the act also recognizes non-fungible tokens, but only when they are used as financial instruments. That is key. It means the law protects investors without over-regulating creators, artists, musicians, and game developers who can keep building freely their NFTs and not turn them into financial products. That balance gives freedom and responsibility. That's what makes good law. And here's another underappreciated win. The bill uses activity-based regulation instead of entity-based. It means it doesn't matter what your company calls itself. If you perform certain activities like trading, issuing, or custodying, you fall under regulation. That's how modern frameworks work. The US is still struggling with this, debating whether something is a security or a commodity. Kenya avoided that drama entirely by focusing on what you do, not what you are. Clarity is gold in regulation. Economically, this move could unlock a lot. Once the licensing process starts, crypto firms will be able to open bank accounts, raise funding, and even participate in regulated investment markets. The ripple effect: more jobs in compliance, legal tech, blockchain development, and fintech integration. Kenya could become a regional hub for crypto infrastructure, especially for startups that want to serve other African markets but need a jurisdiction with clear rules. From a technological standpoint, the Act also emphasizes cybersecurity. Every license provider must implement systems that safeguard client data and prevent unauthorized access. That's just not paperwork, it's how you build digital trust. We've seen too many African exchanges go down because of basic security lapses. With these standards in place, customers can finally feel safer, keeping assets locally instead of fleeing to offshore platforms. And here is where Kenya really nailed it. Tone. The act does not come from a place of fear. It doesn't read like a government trying to control crypto. It reads like a country trying to understand it. That's rare. Compare that to India's early approach: massive taxation, inconsistent bans, and a public message that crypto equals speculation. Kenya, on the other hand, frames this conversation around inclusion, transparency, and growth. It's a language of opportunity. The global response to such laws is usually mixed, but history shows that countries that embrace precise, innovation-friendly regulation always win in the long term. Think of Dubai's VARA, Singapore's PSA, Switzerland's FINMA crypto guidelines. These frameworks didn't scare away innovators, they attracted them. Kenya's act, if implemented wisely, can do the same for East Africa. And finally, Kenya did something that sounds small but means everything. It created a legal foundation for dialogue. Before this act, crypto businesses could not sit at the table with regulators. Now they can. The conversation shifts from "are you allowed to exist?" to "how can we make this ecosystem stronger?" That's what maturity looks like in a market. It's how trust is built, block by block. Of course, the act is not perfect. There are still some gaps, things that could slow down innovation or create unnecessary bureaucracy. We'll deal into those next. But credit where it's due. Kenya's regulators have shown courage and foresight. They didn't ban, they built. They didn't run, they researched. The long game of digital finance, that mindset is everything. This is not the end of the conversation, it's the beginning. Because once you have a framework, the real challenge starts: keeping it flexible enough to evolve. In episode 3, we are going to talk about precisely that: the parts Kenya missed and why these gaps could make or break its crypto future. Stay tuned.